Welcome to part 2 of our series on option Greeks. In this video, we're going to be looking at gamma. So if you remember in the first video we covered delta, well, gamma has a very close relationship to delta. It gives you one additional important piece of information when considering a trade. So please hit those like and subscribe buttons and stick around after the intro. We'll show you how to incorporate gamma into your option trading. All right, so just want to show you real quick where to find gamma in your trading platform. So this is Thinkorswim. If you're using something different, it's probably very similar. There should be a tab just like this that's called Layout, and just make sure the Greeks are selected. So you got your delta, gamma, theta, and vega, and that gives you all your Greeks. So last video, like I said, we did delta. In this video, we're going to be looking at gamma. So both for calls and for puts, it gives you the gamma value. Now, just one thing I want you to note from the screen before we get into the definition of gamma is you'll notice how with delta, the range was from 0 to 1, and it would start, on one end, on out of the money, it would be close to 0 or at 0, and the values increase as you get to the at the money range, and in the money, the values just keep increasing. Well, you'll notice with gamma, it's quite a different pattern. The range technically is still 0 to 1, although I've never seen a gamma of 1. But you'll notice that gamma tends to be higher right around at the money and then really drops off to 0 both deep in the money and deep out of the money. So just take note of that, and we'll come back to that here shortly and explain why that is. All right, so just like in the video on delta, let's start off with what is gamma. So from a purely mathematical perspective, it's basically the second derivative of the option price with respect to the price of the underlying stock. Now, if you remember delta, it was the first derivative of the option price with respect to the underlying stock. So if gamma is the second derivative, that means gamma is giving us the rate of change in delta due to a change in the stock price. Confused yet? Well, here's an analogy. Hopefully this will make it a little clearer. So you have a car moving down the road. In order to calculate the velocity of that car, you basically take the first derivative of distance with respect to time. That gives you velocity and basically tells you how fast the car is going down the road. How fast the location is changing with respect to time. Well, when you take the second derivative of distance with respect to time, you get acceleration. So that tells you how fast the speed is changing. Well, delta and gamma work the exact same way. Delta is like your velocity, and gamma is like the acceleration. So why is this important? Well, gamma tells you how much delta is going to change for every $1 change in the stock price. So if you remember from the last video, delta gives you the change in the option price for every $1 change in the stock price. But delta is not constant. Delta also changes. As the stock price changes, delta changes. So that's what gamma tells you. One important thing to note about gamma, if you remember from when we looked at the trading screen, gamma is always positive. So what that means is if you're long options, it doesn't matter if you're long puts or if you're long calls, your gamma is always positive. So by definition, that implies if you are short options, if you're short calls, or if you're short puts, your gamma is going to be negative. Now, positive gamma just means that delta is going to change in the same direction as the stock price, where negative gamma means your delta is going to change in the opposite direction of the stock price. So now that we understand what gamma is, how do we use it in trading? Well, as far as using it to profit on a trade, there is one very advanced trading strategy called gamma scalping. Now, it's a very complicated, very advanced, very time-consuming strategy. It's not really something that most retail traders would want to get into. Personally, I don't use it myself. But large institutional investors or hedge funds, they do use this strategy. So there's lots of information online on it, lots of other videos or articles you can find on it. Wouldn't be a bad idea to look it up just so you understand how it works and kind of get a feel for what they're doing. It does help to understand some of the moves you'll see in the stock market. Now, somewhat related to gamma scalping is a thing we call a gamma squeeze. A gamma squeeze can occur in the market when there's a very high interest in going long call options. So this happened in, I believe it was June of 2021. It happened with a few different stocks, AMC being one of them. And what happens is there's a really large demand for buying short-term calls. Somebody has to sell those calls to you. So typically it's the market makers, the big institutional, the hedge funds, they sell those options to you. Now, what they do when they sell an option is they partially cover that risk by buying the stock. So what happened in 2021 is that retail traders started buying call options in huge volumes. And these institutional investors kind of got caught off guard. They were selling these call options, buying the stock, but every time they buy the stock, the price would keep going up. And as the price went up, more and more people were buying calls, and the thing just kind of spiraled out of control. And that's called a gamma squeeze, because the delta starts increasing so quickly that all these people that are buying the call options are making really fast profits, and those that are selling the calls and buying the stock are getting caught short. So that's just something to be aware of. When something like that does happen in the market, it's a great opportunity to make some really quick profits if you can catch it early enough. But there is one more key feature of gamma, and that's how it relates to time. Gamma increases as you get closer to expiry, especially when you get within 2 weeks of expiry. That's the reason why most option strategies, like bear put spreads, bull put spreads, typically when you're putting those types of trades on, you're looking about 45 days out in advance when you're opening the position. And usually you're looking to book profits somewhere prior to 21 days left to expiry. Now, that's not to say you should never hold options within 21 days. I mean, quite the opposite. I frequently sell weekly options to collect premiums, such as part of a covered call strategy. But you just have to be aware of what the value of gamma is at the time and incorporate that into your overall risk management plan. You just have to know that as you get very close to expiry, changes in the stock price will have a much bigger effect on delta than they would if they're farther out in time. And it just makes sense logically, because as you're getting close to expiry, there's not a lot of time value left in that option. Most of the value of the option is the intrinsic value. So any little change in the stock price will have a pretty big impact on the option price. And that's why gamma is so high close to expiry. All right, so let's go back to the trading platform just to take a look at some of the things we talked about. So first, let's look at the time value effect on gamma. It doesn't matter which ticker, this is AI, it doesn't matter which ticker you look at. If we looked at something, say a couple months out, a few months out, like October, and you look at the gamma values, you'll see how low they are. They're 0 and they only get up to 0.03 before starting to drop off again. So at that point, a move of $1 in the stock has almost no effect on delta. Now, conversely, if we're looking at options that are expiring within a day, you can see the gamma values are way higher. So now instead of 0.03, we got 0.29, 0.26. So the gamma values are much higher as you get really close to expiry. All right, and lastly, so at the beginning of the video, we talked about how the values tend to be close to 0, both deep in the money and deep out of the money, and then at the highest at the money. Well, why is that? So remember, delta goes from 0 to 1, and that sweet spot of, the 0.4s, the 0.5s, the 0.7s, that's typically right near the money. Well, when your delta values are at extremes, so for example, when you're so deep in the money, the stock price is at $31. If you're so deep in the money that you're looking at strikes of, $15, $17, $20, your delta is already 1. It can't go any higher, okay? And the stock would have to drop a lot in order for this to go down from 1. So that's why your gamma is at 0. Like if this stock price drops from, $30, say down to $29, this $15 call is still going to have a delta of 1 because it's so deep in the money. That's why your gammas are 0. The same thing happens when you go really far out of the money. If you're looking at call options that are, $40, $41, that's $10 away from the current stock price. A $1 move, up to $31 or $32 is not going to have an effect on delta. So again, that's the reason why the gammas are 0 that far out of the money. Now, at the money, that's where you have the biggest changes. If you buy a $30 call option and the stock is currently at $30.65 and it goes up by $1, that's a pretty significant change. So that's going to affect your delta. So your delta then will increase from this 0.68 by another 0.25. And that'll be your new delta value. So that's really all there is to know about gamma. Hopefully that made sense and you learned something from this video. If you're enjoying this content, please hit those like and subscribe buttons, and we'll see you next time.